This lesson is going to serve as an introduction for you to market structure, which will be an entire section of the trading lessons. Market structure as a whole deals with the turning points of where trends end, where new trends begin, and broadly how to identify the best entry and exit points for your trades. It is the cornerstone of everything you do. Market structure is the most important thing you will learn in price action. Everything I've talked about up to now, about trends, mean reversion, and waves and cycles, it all flows into market structure for when you actually go to trade on the charts. Because a lot of this is very, it's all very well saying trending, ranging, what type of phase are we in? But when it comes down to executing a trade, you need to understand market structure on all levels. So there are two theories, Wyckoff theory and Dow theory, which are the predominant theories in this field. And for me, the way I teach and the way I trade, I view it this way. Wyckoff theory is the best for your higher time frame view of the market. It deals with fundamental laws such as supply and demand, cause and effect. We'll get into that a lot more in the Wyckoff lessons. But basically, if you view it from a broad, an overview of an entire bull market or an entire bear market, where does it start? How does it travel? And where does it end? Wyckoff theory is the best example of that. The Wyckoff logic has been covered in the 4 phases lesson: accumulation, markup, distribution, markdown. You see on the schematic on the top right. There's a little bit more information on that, which we'll go into in the Wyckoff lessons, including volume and including the nature of what happens at different areas and the areas where you can spot high probability accumulation or distribution. Dow theory is much more basic and was the first real principle of market structure in analysis from many, many years ago, from Charles Dow, who pioneered it. And that is the basic of what we call market structure, which is higher highs and higher lows is an uptrend, lower highs and lower lows is a downtrend. So if you look on the bottom left here, higher highs, higher lows, higher highs, higher lows, all the way. You then have a change of character where it shifts. Price goes down through the previous higher low, which is called a market structure break. We then proceed into a downtrend of lower lows, lower highs, continuing to the bottom. Dow theory as well also explains the same concept of the fractal nature of markets through the lens of primary trend, which is the general trend of the market, intermediate trend, which is, like your swing trading that we talked about, and minor trend, which is every fluctuation in between. I show both of them because it's very good to understand that two of the most fundamental theories about markets both broadly agree with each other. Understand? You should really be crystallizing and forming an idea now of markets do not move in a random fashion. There is order to them. At certain points in certain periods, they can move randomly, but on a higher time frame, they always move with intent. So click through to the next lesson. Let's dig into it.